Okay. So that day we have discussed the conceptual framework for financial reporting, IASB. The objective of general purpose financial reporting, I told you the purpose is nothing but to know the profit or loss of the performance of the company. Reporting entity is the one which issues or prepares the financial statement at the end of the year. Qualitative characteristics of useful financial information, we had a discussion. That day almost we had a lot of discussion. It should be relevant, faithful representation, substance or form is already explained. I have also explained you the changes in accounting policy. Acha. What about the changes in accounting estimates? What you should do? Hello? What should you do for changes in accounting estimates? Can you tell me? Come on, please try to participate.
So there is
Hello.
some retrospective effect.
Sorry. Hello. See, changes in accounting estimates is nothing but if the company has made bad debt provision at the rate of 10%. So now company's sales have increased. Previously they were selling 5 lakh worth of goods. Now they are selling 10 lakh worth of goods. So when their sales have doubled, they thought of increasing this bad debt provision from 10 to 15%. So now they have to give a prospective effect to it. That means they should deal prospectively with this. The meaning of prospective effect is now the change has been made, okay, and till the next change will not be made in the provision, 15% would be followed. That is called, from now onwards the company would be following 15% as bad debt provision. That is called prospective effect. Okay, we have already done this. Verifiability, whatever you are showing in the books should really be there so that it could be verified. Timeliness, everything what you are preparing should be prepared on time. 1 year is generally the time period in which the financial statements are prepared. Okay. Understandability, the statement should be prepared in such a way that it should be easily understandable. That means anyone can easily understand that expense, income, asset, liability, all these things would be there. They could easily make out what is really this complete statement all about. And of course you are giving disclosure requirements also, no? So that will make them more easier to understand the things, correct? The cost constraint on useful financial reporting, this is a pervasive constraint. What do you mean by constraint? Any idea? Constraint is nothing but bottleneck resource or limitation. So when information is provided, its benefits must exceed the cost of obtaining and presenting. Hello? Hello? Any doubts? You were saying something. Hello? Are you able to hear what I'm saying, both of you?
Yes, sir.
Yeah. See, when information is provided, what is the information here? The financial reports of the company. Its benefits must exceed the cost of obtaining and presenting it. That means the benefit, there is nothing comes for free. Everything has a cost. So the cost here is nothing but to prepare the financial statement. The staff has to be paid and everything matters here. Everything matters in the sense the company has to hire accountants, like senior accountants. They would make the statements and everything. So the benefits must exceed the cost. So the financial reports, whatever is prepared, it is very much beneficiary for the stakeholders. So that the cost what company is incurring to prepare those statements is is very less when compared to the benefits what it can give to the stakeholders, the owners, correct? So this is a subjective area and there are other difficulties. Others, not the intended users, may gain a benefit. See, there are many people who are not the users who would like to, who has any work with the company's financial reports. But if they also know about companies reports, like companies competitors, They have nothing to do with the company. Why? Because they have not invested anything in the company. So if they also get the information, they come to know a lot of things about the company. Also, the cost may be paid by someone other than users. It is therefore difficult to apply a cost to benefit analysis, but preparers, the company, so accountants and the users should be aware of the constraint. So definitely the benefit of like publishing a financial state by benefit of preparing and publishing a financial statement should always like be more than the cost. Okay, that means that should be more beneficiary than what the cost the company is putting to prepare them. We have already discussed about the elements of financial statements. We have already discussed about the stakeholders even in the previous class. Am I right? Did we do the stakeholders thing? Hello? Hello?
So stakeholders you didn't, sir.
Okay, we'll do it right now, no problem. See, now I would ask you a question. The company prepares the financial statements, correct? For whom they prepare?
For stakeholders and other outside
Yeah.
users.
So stakeholders can be divided into two parts. They are
internal and external.
who are the internal users of financial statements?
Managers, employees,
Who are the external users of financial statements?
suppliers, customers, government,
Lenders.
competitors.
All these guys definitely want to know about company's financial position, right? Because they all are connected with the company in some way or the other, and everyone has something or the other. Everyone has like some. Everyone can gain something or the other from the company. So they want to know their benefits, what they can get from the company. That they can really get an idea if they know the company's financial performance at the end of the year. So they want to know about the they want to know about or study about the company's financial statements. Okay, so directors make promises to the investors that they would maximize the health, maximize the financial wealth of the investors. Correct?
Yes, sir.
The directors would maximize the financial wealth of the investors. The board of directors make promises to investors that they would maximize their wealth and make company profitable. If the company is in profits, their promise what they have made would definitely get fulfilled. Management kind of these guys are the ones who take crucial decisions, and if company is in profits, that means the management whatever they have planned and whatever they have whatever the strategies they have prepared, those have worked out for the company because company has got profits. So their strategies have worked out and everyone wants to work with good management, so management would be rewarded for their good efforts to make company more profitable. Employees, see, employees want salary hikes and promotions and all that is expected from a company which is more profitable. Okay, investors want profits and dividends, so they want to know the company's financial statements at the end of the year and want to know whether the company has earned good profits or not, whether they will get their share of profits and dividends, or their shares value have grown or not, after they have bought the shares. And customers want good quality products. They can expect that from a very good company which always fulfills all the compliances and earns good profit. Government wants taxes. That is also, they want to know whether company is in profits or not, because their taxes would be paid if the company is in profits. Government want charity, pressure groups, NGOs want charity. You can expect that from a profit making company, not from a loss making company. So these are the decisions what investors make after seeing the financial reports. What are the decisions they make? Whether they have to buy or they have to hold or sell the shares of the company. Assessment of management, stewardship, and accountability. Like if the company is preparing financial statements and disclosing everything, management would know like how well the directors have like, see, there is a relationship between the directors and the investors or shareholders. What kind of relationship? Principal agent relationship. Excuse me. Excuse me. Yeah. So assessment of company's ability to pay employees. So like there's a principal agent relationship between the director and investors. So whatever the promises these guys have made to them, these guys have to fulfill. Okay. So like whether these guys have fulfilled their promises or not, that can easily be known by seeing the statements of the company. And accountability. See, statements are nothing but it displays accountability from the company's part or from the like directors and management's part. How? Because everything is disclosed, nothing is hidden. Correct. Excuse me. Excuse me. Yeah. Now, assessment of the security of amounts lent to the entity. Acha, like if company's balance sheet or income statement is seen, if they are in profits, the employees can be paid timely, and there wouldn't be any kind of delay in the payments. Dividends can be paid, tax can be paid. All these things we discussed already, almost all. And yesterday we have discussed about the IFRS also, why it is so important. It makes because of the IFRS today the world has become a global. The world is a village now. Okay, so it's like
Converged.
it. Hello.
Converged, no, sir.
Yeah, conversions are happening, and harmonization of regulations, accounting standards is happening. So this is what is not. That's okay. Just read this question. Already we have discussed. Once you can go through this. Okay. So what did you understand, Rajeshwari, from this?
Yes, sir.
What did
Sir,
you
can you
understand
hear
from
me?
this? I can hear you. What did you understand from this?
Sir, investors like they need to know like the share prices when they are buying or selling. They need to know the information so that they can make their decisions.
Okay, okay.
Yes, and like they need to know that whether the company is running good or is it stuck anywhere or is it not performing well,
Okay.
and knowing the liquidity position of the company by looking into the statement of P&L and OCI and
Hmm.
the balance sheet.
Okay.
Yes.
So they can know about the investors are providers of risk capital. That means they take risk and they want
Yes.
returns. Okay. So information is
Yes.
required to help make a decision about buying or selling shares, taking up rights issue and voting. What do you mean by this?
So voting means
See, consider the information needs of users. So what kind of information they have and what is the need of that? How that information can help them. So information is required to help make a decision about whether they want to buy or sell, or they want to take a rights issue. That means existing shareholders. These are existing shareholders. The company will issue shares to them again because these are existing shareholders, and rights issues nothing but the shares are issued to existing shareholders. So whether they have to take that or they have and they have to vote. Investors must have information about level of dividends, like how much dividends they're going to get, past
yes.
dividends, what they've got, present, future, and any changes in share price. Investors will also need to know whether the management has been running the company efficiently, of course, as well as
Yes.
the position indicated by the statement of P&L and L and other comprehensive income statement of. So they want to know about the SOPL, SOFP, EPS. They want to know about the liquidity position of the company, future prospects in the company, and how the shares. They would compare the share price today. If it is 110, when they bought it was 50. They would compare these also. Okay, and they would compare the company in which, suppose I have invested in Tata Power. There is Adani Power, Reliance Energy. So I will see whether how this and these are giving profits. Suppose Tata Power has risen by 10%, Reliance has risen by 7%, Adani Power has risen by 5%. So I'll go for Tata Power. I would always check the competitors also. Correct?
Yes, sir.
Employees need information about security of. So I have already explained this. We have already done it in brief. Correct? So you can just give a reading to this. We have already discussed this in brief, briefly. We have already discussed this in brief just a moment ago. Correct. So please go to this. Everyone has something to know. Lenders want to know about company's profitability, whether company can pay interest and principal amount. Suppliers want to know whether company's revenues are good, whether company is been generating profit, so that they are not worried about company like not paying them. Okay, so they want their money back. So company, they expect company to pay the debts what company have towards these guys, that they can expect from a profitable company. So all this we have discussed. Please go to them once. We'll go for the last and conclusion part of the chapter.
Done, sir.
Done, sir.
Yeah, just a second. We prepare the accounting. See, in the books of accounts, whatever we prepare it on what basis? What is this
Accrual
basis?
basis.
Accrual
What is that?
basis.
What do you mean by accrual basis and what is
Earned,
cash basis?
earned but not received. Accrual basis.
See, accrual basis is nothing but outstandings and prepaids are also shown in the books of accounts.
Yes, sir.
Accounting doesn't take into picture the cash receipt and cash payment aspect. Okay. So the expenses are recorded when they are incurred rather than
Earned.
paid.
Paid.
Incomes are recognized. Incomes are recognized when they are earned rather than
Received.
received. Did you understand? Please tell me. Please tell me.
Yes, sir.
You have an idea about this. If I'm not wrong,
Yes.
every company which prepares the statements is preparing the statements based upon the underlying assumption that it is a going concern. That means they will run the company continuously, not a seasonal business.
Yes, sir.
Yeah. Now almost all done. We are into the last page, the conclusion part of this chapter. See, recognition criteria is done. Now only the measurement basis is what we have to do. So measurement of elements of financial statements. A number of different measurement bases are used in financial statements. So the assets can be, or the items in the statements can be shown at historical cost, current cost, realizable value, present value of future cash flows. So we will see. So historical cost, that means the cost at which you bought it. You can show at that cost. Are you understanding what I'm saying? Hello?
Yes, sir.
Hello?
Yes, sir.
Assets are recorded at the amount of cash or cash equivalents paid or fair value of the consideration given to acquire them at the time of acquisition. Suppose I want to buy a piece of land and I'm paying 10 lakh. That is nothing but cost to me. For other guy it is a revenue. That is secondary matter. For me it is a cost. And he will charge me as per the fair market value. Got it? Now,
For his fair market value.
yeah, he will charge the fair market value. Whatever he see, he will definitely see what people are ready to pay. So he will charge like that. Liabilities are recorded at the amount or of proceeds received in exchange for the obligation. So liabilities are recorded at the amount of proceeds received in exchange for the obligation. So what is that liability? What is this?
Can you repeat once again, sir? I couldn't hear.
Liabilities are recorded at the amount of proceeds received in exchange for obligation. See, if I take a 10 lakh rupees loan, I'll show 10 lakh rupees as my liability. Finish.
Yes.
For example, okay, so this is done. In some circumstances, for example, income taxes at the amounts of cash or cash equivalents expected to be paid to satisfy the liability in normal course of business. So they make provision for tax now. So what they are expecting to pay in the future, based upon that, they will show the income taxes. What do you mean by current cost? Assets are carried at the amount of cash or cash equivalents that would have to be paid if the same or an equivalent asset was acquired currently. So what is current cost? I have to pay some, I have to buy a asset. Okay. So today at what cost? Today at if I go and buy, what is that I need to pay that pay for that? Is that my current cost?
Yes, sir.
See, I can show assets at historical cost, the cost at which I bought, or current cost. Current assets are carried at the amount of cash or cash equivalents that would have to be paid. That means that you will pay If the same asset, if you acquire right now, did you understand? See, today if I want to buy something, it is available for 100 rupees. Tomorrow if I go, it is available for 101 rupees. I know the difference is negligible, but what is the current cost?
100.
100, that's it.
So
Realizable value.
historical cost is also when you're acquiring it only, no sir?
Yeah, historical cost is the cost at which you bought it. Current cost is if you today pay what it is available for.
Okay.
So now how do you differentiate between the historical and current cost? Historical means the price at which I bought. I'm showing that. Current cost is today what I'm
Okay.
getting for that. I will show in that way.
Okay, sir.
Realizable value is also called as settlement value. That means I want to sell a land for 10 lakhs. I hired an agent for that. I told him I'll pay you 10% commission. So now the deal is done. He got a customer. So 10% commission of that is nothing but 1 lakh. I need to give to agent. Now how much is that? How much is the price at which I'm going to sell? How much is the price I'm going to sell? My God, how much I got in my hands? 10 lakhs I got for asset which I sold, minus 1 lakh I gave
Yes.
commission to agent. How much?
9
9
lakhs.
lakhs.
This is the realizable or settlement value now. Realizable value now. Please tell me.
Yes,
Yes.
sir.
So nothing but selling price minus cost of disposal. Selling price minus cost of disposal will give me realizable. Now settlement value. The undiscounted amounts of cash or cash equivalents expected to be paid to satisfy the liabilities in normal course of business. What do you mean by this? Undiscounted amounts. See, discounted amounts are nothing but in future whatever I am going to pay, the present value of that. Undiscounted amounts is nothing but I have not done the discounting. I have not done the discounting. So undiscounted amounts of cash or cash equivalents expected to be paid to satisfy liabilities in normal course of business. Whatever I am going to pay in the future, that is what is my settlement value. Nothing but 10 lakh is what is my liability, boss. When I
Okay, sir.
went, like I just like I have been given like 5 years to pay this. I just after 6 months I called the bank. I told, see, I will pay you right now, pre-closing. I'll pre-close this. I'll pay you right now, right away. How much discount you're going to give to me? He said 50,000. I'll reduce. So how much I'm paying? Or please tell me how much
9
I'm
lakh
paying.
50,000. 9 lakh 50,000.
9,50,000.
Hello?
To make the payment in 1 month.
Hello.